Greetings, salutations, Zlavo. However you say it in your neck of the woods, I'd like to welcome you to another episode of Le Art of Reading Price Action. Again, welcome to another episode of The Art of Reading Price Action. And in this episode of The Art of Reading Price Action, we are on part dos. That's right, part 2 of Le Order Flow. And my name is Timothy Lee Rogers Sr., aka Aranya Grande. That's Big Spy for those that don't hablo Espanol. And if you would like to join the paid portion of this mentorship, there is a join button here on the tube. You just click the join button and pick the tier that says Mentees. We've been doing this long enough. Y'all know how to join the paid mentorship. It's $24.99 a month. And you know what it come with. If you don't know what it come with, look at another episode and you'll know what it come with. Without further ado, let's get into the art of reading price action. Order flow, part 2. Order flow. We're going to touch on buy programs and sell programs in this. In its simplest form, buy programs is when price is bullish. Sell programs is when price is bearish. But they are key indicators, key signatures, should I say, that you want to look for when you're trading the ICT concepts when it comes to buy programs and sell programs. Buy programs. In a buy program, IPTA will perform one of 2 price engine models, right? We always look for signatures. Remember I told you, look for signatures, right? And a buy program is gonna perform one of 2 price engine models. That's the offset accumulation and the reaccumulation. I know it sounds super fancy, but we're gonna read what it is and then I'm gonna tell you what it is in simple terms, okay? Accumulate sell side liquidity by repricing under an old low. Sell stops will be triggered, inducing counterparty sellers to pair long entries with. Right? Price will seek a higher short-term premium array to offset positions. Reaccumulate fair value in retracements lower at discount arrays. Weak long holders will be squeezed in this retrace lower, right? Price will seek to expand higher to a short-term premium array to offset positions. Whoo, that's a whole mouthful. You're probably looking like, what did Tim just read? Let's continue. Okay, offset accumulation. IPTA will reprice the market below an old low to promote sell stops that would be residing there for current long holders. This is in essence engineering sellers to at a deep discount price, right? It's making people get in and sell at a deeply discounted price, okay? The open float below the old lows may also have sell stops for breakout systems that wish to sell on weakness. Remember when the breakout traders you got sell stops sitting down there for people that's already in longs, and you got sell stops sitting down there for people who want to get short on a breakout, right? So the open float, that's just the liquidity pool with open orders sitting down there waiting to get in to go short on a breakout. This model is called offset accumulation. Its primary purpose is to offset current long holders and or induce more selling at discount prices. The model is seen frequently in bullish market conditions, and while higher time frame institutional order flow is suggesting higher prices, right? Typical offset accumulation models unfold quickly, and you must learn to anticipate them at key lows intraday. Reaccumulation. IPTA will reprice the market lower to a fair value price array to provide smart money discount prices for long entries. The market will be bullish from an institutional perspective and many times unfold after recent sell stop raids. The retracement lower in price will place pain on current long holders and tend to induce selling, thus providing sell side liquidity to pair smart money long entries with. This model is called reaccumulation. Its primary purpose is to reaccumulate new long entries and or induce more selling at discount prices. The model is seen frequently in bullish market conditions, and while higher time frame institutional order flow is suggesting higher prices. Typically, reaccumulation models unfold quickly, and you must learn to anticipate them at key discount arrays intraday. Whoo, that's a whole lot of reading, a whole lot of saying, a whole lot of words. Now, what does that really mean in its simplest terms? What simplest form? Offset accumulation. Nothing more than a stop sweep, liquidity sweep, stop run, whatever you call it. It's just when the market sweep stops. Judas swing, turtle soup, Le Judas. That's all offset accumulation is. Reaccumulation, just a retracement back to fair value, like coming back to a fair value gap. That's all it is in simplest terms, right? Where can you anticipate seeing offset accumulation? At an anticipatory reactionary point, or when price comes to, how price comes to equilibrium, it's in like 50% of the range, and it'll tend to start consolidating. If price is still bullish, it will sweep the lows again before continuing up. That's a key factor in knowing if you're still in the buy program. Why? Because the PD arrays below price, like swing lows and bullish fair value gaps, these PD arrays that are below price, not just below in a discount, but below price as far as discount, they will support price. They will support bullish price. So swing lows, if they get swept, it'll be a quick sweep and reject off quick. Fair value gaps, it'll be a quick dip and reject off quick. Down close candles, it'll be a quick touch and take off quick. Any down close candle, bullish fair value gap, and swing low in a buy program will support price. And when they start to fail to support price, that's when you may have a clue that the buy program is over. And you may be getting ready to go into a sell program. Now, the key difference between the sell program and the buy program is the name. In the buy program, you got offset accumulation and reaccumulation. In the sell program, you got offset distribution and redistribution. Everything else is pretty much the same, except for you're running highs instead of running lows, and you're retracing back to bearish fair value gaps instead of bullish fair value gaps. You're retracing to premium arrays instead of retracing to discount arrays. Okay? Now, in a sell program, IPTA will perform one of two price engine models. Accumulate buy-side liquidity by repricing above an old high. Buy stops will be triggered, inducing counterparty buyers to pair short entries with. Price will seek a lower short-term discount array to offset positions. Reaccumulate fair value in retracements higher at premium arrays. See, you're going to the premium instead of to the discount. You're going to highs instead of lows. You're going to bearish PD arrays instead of bullish PD arrays. Just flipping it over on his head. Offset distribution. IPTA will reprice the market above an old high to promote buy stops that will be residing there for current short holders. This in essence engineers buyers at premium prices. The open float above the old high may also have buy stops for breakout systems that wish to buy on strength. You see how it's the mirror of offset accumulation? Just the opposite. Strength, weakness, premium, discount. Just the opposite end. The model is called offset distribution. Remember, that's the key. In the sell program, it's offset distribution, and the buy program is offset accumulation. And the sell program is redistribution, and the buy program is reaccumulation, right? Its primary purpose is to offset current short holders and or induce more buyers at premium prices, force them to pay more than they really want to pay. The model is seen frequently in bearish market conditions, and while higher time frame institutional order flow suggests lower prices. So you're anticipating the market to drop, so you want to see it manipulated up and then continue down. And redistribution, again, is just like reaccumulation, except for you're moving to the premium and you're attacking highs instead of moving to a discount and attacking lows. Right now, let's see what it looks like. Simple terms. Just like in the offset accumulation, the offset distribution is just a stop sweep, a stop run, a stop raid, whatever you want to call it. When price sweeps highs and then displaces lower. Okay? And redistribution, it returns to fair value. You go back to a bearish fair value gap. You move back up to a bearish order block. When you return back up to an area of fair value and then continue down. And just like in a buy program, as long as you see premium PD arrays, meaning PD arrays above price, not only in a premium, but PD arrays above price, resisting the price action, then you know the sell program is intact. Swing highs, if they get touched, they reject quickly. Bearish fair value gaps, when they get touched, they get respected and push price down. Up close candles, if you trade back into them, they resist price. So swing highs, bearish fair value gaps, up close candles, you want to see them all resisting price to know that the sell program is still intact. Now, that's just a quick introduction to the buy and sell programs, the buy programs and sell programs. Now, since I am on vacation, there is no official homework for this week, but do not fret. For those of you who are trading already, yes, the mentorship is designed for those that's not trading yet. But I know there's people in the mentorship that actually trades. So what I am including in this slide deck is some slides, bonus material, if you will, straight from Michael's core content. It's going to talk about 5-day average daily range and how to use that in intraday scalping models for long setups and for short setups. And I have slides in here for you to go through and look at on your own, in your own time, at your own free will, so that you can see if you can apply this to your trading strategy. And I have the slides in here for those that trade the London session, right? Straight off Michael's content. This is a model for intraday scalping in the London session. This is a model for intraday scalping in the New York session. So I got all bases covered for everybody, okay? And this is your short model for the London and your short model for the New York. All bases covered for everybody. Go through it in your own time. You have to download the slides to get this. And that brings us to the end of another episode of The Art of Reading Price Action. I'd like to thank you for tuning in to another episode of The Art of Reading Price Action. Like I said before, my name is Timothy Lee Rogers Sr., a.k.a. Aranya Grande. That's Big Spider, if you don't hablo español. Until next time I decide to get on Algo's internet and share my thoughts on this thing we call price action, man. Y'all be safe out here in these trading streets. I'm gone.